Welcome back to Capital Lens, where we cut through the noise and give you the financial insights that actually matter. Today, we're diving into the biggest story in global markets right now, the oil crisis of 2026, and exactly where smart investors are putting their money. On February 28, 2026, the world changed overnight. U.S. and Israeli forces launched coordinated strikes on Iran. Iran responded by doing the one thing the entire global economy feared most. They shut down the Strait of Hormuz. In less than 72 hours, oil prices went from $70 a barrel to over $110. The Dow Jones fell more than 400 points in a single day, and gasoline prices in California surged above $5 per gallon. Right now, as you watch this video, the world is facing its most serious energy crisis since the 1973 Arab oil embargo. And millions of investors are asking the same question. What do I do with my money right now? Do you buy oil stocks and profit from the crisis, or do you buy gold and protect yourself from what comes next? In this video, I'm going to give you a straight answer, based on real data. From Fortune, CNN, The Motley Fool, and U.S. News, no fluff, no guessing, let's get into it. Before we talk about where to put your money, you need to understand exactly what is happening and why it matters. On February 28, 2026, the United States and Israel launched a joint military operation targeting Iranian leadership and military infrastructure. The operation, codenamed Operation Epic Fury, included the assassination of Iran's supreme leader, Ali Khamenei. Iran's response was immediate and devastating. They deployed naval mines and drone swarms across the Strait of Hormuz, the narrow 21-mile-wide passage between Iran and Oman. Here is why that matters to your wallet. The Strait of Hormuz handles roughly 21 million barrels of oil per day. That is nearly 20% of all global oil supplies and approximately 25% of all global seaborne trade. When that strait closes, the entire world feels it. China, Japan, South Korea, Europe, every country that imports energy through the Persian Gulf is now in crisis. The numbers tell the story clearly. Oil prices surged from $70 per barrel on March 1st to over $110 per barrel within days. That is a 57% increase in less than 2 weeks. The last time we saw oil at these levels was during Russia's invasion of Ukraine in 2022. Economists are projecting the Consumer Price Index could jump nearly 0.9% for March 2026 alone, the largest one-month spike in years. The Federal Reserve is now caught in what analysts call the stagflation trap. Raise rates to fight inflation, and you crush an already struggling economy. Hold rates, and inflation spirals out of control. There is no good option. Now, let's talk about oil stocks, because what happened here is not what most people expected. You would think oil prices spike 57%. Oil stocks should rocket up too, right? That is not what happened. Here's the data from Fortune and The Motley Fool as of March 12, 2026. ExxonMobil, up nearly 30% year-to-date. New record high, $643 billion market cap. Chevron, up over 30%, nearly $400 billion in market cap. Occidental Petroleum, up 43%. Venture Global, up 92% since January 1st. Those numbers sound incredible, but here is the catch. Most of those gains came before the war started. Since the war started, oil stocks have barely moved. The Motley Fool reported this clearly. ConocoPhillips is only up modestly since the conflict began. ExxonMobil's stock has actually slipped slightly. Why? Because the market is betting this disruption will be short. If the strait stays closed for weeks, oil could hit $150 or even $200 per barrel, and oil stocks would explode higher. Wells Fargo just raised its price target for ExxonMobil to $183 from $156. Chevron has a 4.5% dividend yield and a buy rating from most analysts. Bottom line on oil stocks. High upside if the conflict drags on. High risk if the strait reopens and oil crashes overnight. Now let's talk about gold. Because gold is telling a completely different story. Gold has already surged past $5,300 per ounce since the conflict began. J.P. Morgan has raised its year-end gold target to $6,300 per ounce. Why is gold surging? 3 reasons, all happening at the same time. Reason 1. Safe haven demand is exploding. Every time the world faces serious geopolitical risk, investors flood into gold. It happened in 2008. It happened in 2020. It's happening again right now. Reason 2. Inflation is back. The CPI is expected to jump nearly 0.9% in March alone. In 2025, gold gained 60%, its biggest single-year increase since 1979. It is already up another 12% in 2026 before this crisis began. Reason 3. Central banks are still buying. 3 consecutive years of record central bank purchases. China, India, Russia, Turkey. They are accumulating. What does the smart money say? J.P. Morgan, $6,300 per ounce by year end. Goldman Sachs, $4,900 target, raised before the conflict began. Bank of America, $5,000 target. Bottom line on gold, lower upside than oil stocks if the conflict drags on, but far lower risk if the conflict ends quickly. Gold wins in almost every scenario right now. Scenario 1. The conflict ends. Quickly. Strait of Hormuz reopens in 2 to 4 weeks. Oil prices crash back to $70 to $80. Oil stocks give back gains. Gold holds most of its gains. Inflation concerns remain. Winner. Gold Scenario 2. The conflict drags on, oil stays above $100, potentially spikes to $150. Oil stocks explode. Exxon, Chevron could gain another 30 to 50%. Gold also rises, but more slowly. Winner. Oil stocks, but with much higher risk. Scenario 3. Stagflation. Hits, oil stays high. Economy slows. Fed is stuck. Stock markets broadly fall, including oil stocks eventually. Gold surges, the ultimate stagflation hedge. Winner. Gold. By a significant margin. 2 out of 3 scenarios favor gold. 1 scenario heavily favors oil stocks, but only if you can handle the volatility. Allocation 1. 30% into gold. Not physical gold, no storage needed. By GLD or IAU, the 2 largest gold ETFs in the world. Combined, they hold over $100 billion in physical gold. This is your shield. Allocation 2. 20% into diversified oil exposure. Don't pick individual oil stocks, too much single company risk. By XLE, Energy Select Sector SPDR Fund, Exxon 22%, Chevron 17%, ConocoPhillips 8%. XLE is already up nearly 30% year-to-date. Allocation 3 to 50% into S&P 500 or cash. Keep the majority of your portfolio stable. This crisis will end. Markets will recover. Having 50% in stable assets means you survive the volatility. What not to do? Do not panic sell everything. Do not put 100% into oil stocks chasing the rally. Do not ignore this. Inflation at 0.9% per month destroys purchasing power. Let's bring it all together. The 2026 Iran conflict has created the most significant energy crisis since 1973. Oil prices are up 57% in 2 weeks. The Strait of Hormuz, which handles 20% of global oil supply, is effectively closed. Oil stocks. Enormous upside if the conflict continues, but high risk. Gold, already above $5,300. JP Morgan targeting $6,300. Wins 2 out of 3 scenarios. The smart strategy right now, 30% gold via GLD or IAU, 20% diversified oil via XLE, 50% stable S&P 500 or cash. This crisis will not last forever, but the investors who position correctly now will look back on this as one of the best opportunities of the decade. Hit like, subscribe to Capital Lens, drop a comment below. Are you buying oil stocks or gold right now? I read every single comment. See you next week. In times of crisis, the informed investor always wins.